Hey everyone, welcome back to the channel. If you're new here, make sure to hit that subscribe button because today we're diving into something that could fundamentally change the silver market as we know it. We're talking about an industrial demand crisis that's brewing right beneath the surface, and it's centered around one of silver's biggest consumers, the solar industry. Now, I know what you're thinking. Silver just hit an all-time high of $84.72 on February 11th, and even though we've seen some pullback, we're still trading around $78 to $79 per ounce as of today, February 15th. The metal is up 162% from where it was a year ago. So how can we be talking about a demand crisis when prices are this high? Well, that's exactly what makes this story so fascinating and so critical for anyone holding silver or thinking about getting into the market. Let me start with the fresh data that just came out. According to the latest forecasts for 2026, silver industrial fabrication is expected to decline by 2% to around 650 million ounces. Now, 2% might not sound like much, but here's the kicker. This decline is happening despite the fact that solar installations are continuing to grow globally. Let that sink in for a moment. Solar is expanding, but silver usage in solar is going down. This is what we call substitution, and it's happening faster than most investors realize. The solar photovoltaic industry has been one of silver's crown jewels over the past decade. These panels need silver paste for their electrical conductors because silver is the most conductive metal we have. It's been irreplaceable, or so we thought. But when silver was trading at $20 to $30 an ounce, manufacturers could live with the cost. Now that we're at $78, nearly $80 an ounce, the economics have completely changed. Every solar panel manufacturer on the planet is now in research and development mode, trying to figure out how to use less silver or eliminate it entirely. And they're succeeding. The data shows that the average silver content per solar panel has been dropping year over year. We're talking about companies developing thinner silver pastes, experimenting with copper alternatives, and even creating entirely new panel technologies that use significantly less silver. Some manufacturers have already reduced their silver usage per panel by 30 to 40% compared to panels made just 5 years ago. This trend isn't slowing down, it's accelerating, especially now that silver prices have exploded higher. But here's where it gets really interesting. The silver market is still expected to be in deficit for the 6th consecutive year in 2026. We're looking at a deficit of 67 million ounces. Think about that contradiction for a second. Industrial demand is declining, yet we still can't produce enough silver to meet total demand. How is that possible? The answer lies in investment demand and the supply side of the equation. Investment demand has absolutely surged. Global exchange-traded product holdings are standing at an estimated 1.31 billion ounces. When you combine geopolitical uncertainty, concerns about U.S. policy under the new administration, and expectations that the Federal Reserve will cut rates by at least 60 basis points this year, you've got a perfect storm for safe haven buying. Investors are piling into silver like we haven't seen in years. Markets are currently pricing in roughly 2 rate cuts by year end, and historically, when real interest rates fall, precious metals shine. Meanwhile, on the supply side, we're facing constraints. Mine production isn't keeping pace with total demand. You can't just flip a switch and open a new silver mine. It takes years of exploration, permitting, and development. Plus, about 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. If those base metal prices aren't attractive enough, silver supply gets constrained even further. So we've got this fascinating tug of war happening. On one side, industrial fabrication is softening due to high prices and substitution, particularly in solar. On the other side, investment demand is roaring and supply remains tight. The question everyone should be asking is, which force wins? Let me paint you 2 scenarios, and I want you to think about which one seems more likely to you. Drop your thoughts in the comments because I'm genuinely curious what you all think. Scenario 1, the price-driven demand destruction scenario. In this version, silver prices remain elevated, let's say in the $70 to $90 range for an extended period. At these levels, industrial consumers accelerate their substitution efforts. Solar manufacturers deploy new technologies faster than expected. Electronics companies find ways to use less silver in their components. Electric vehicle manufacturers, another growing silver consumer, engineer around the metal where possible. Over 12 to 18 months, we see industrial demand drop by 5, maybe even 10%. Meanwhile, at some point, investment demand cools off. Maybe the Fed doesn't cut rates as much as expected. Maybe geopolitical tensions ease. Whatever the catalyst, investors start taking profits after this incredible run-up. In this scenario, the combination of falling industrial demand and cooling investment demand could push silver back down to the $50 to $60 range by late 2026 or early 2027. Scenario 2, the structural deficit persists scenario. In this version, yes, solar manufacturers are working on substitution, but it's not happening as fast as the data might suggest. Why? Because changing manufacturing processes isn't easy. You need to retool factories, get new certifications, test reliability over time. These things take longer than a few quarters. Meanwhile, other industrial sectors are actually increasing their silver usage. 5G infrastructure continues rolling out globally, and that requires significantly more silver than 4G. Electric vehicles are still in the early stages of mass adoption, and each EV uses about twice as much silver as a traditional car. AI data centers, which are being built at a record pace, are massive consumers of silver-bearing components. In this scenario, while solar might use less silver, total industrial demand either stays flat or even grows slightly. Combine that with continued investment demand driven by monetary policy and geopolitical concerns, plus a supply side that can't keep up, and you've got a recipe for sustained high prices, or even another leg up toward that $100 level that UBS is forecasting for next month. Now, here's what I think is most likely to happen, and this is based on analyzing the market data, historical precedents, and understanding how these cycles typically play out. I believe we're going to see a combination of both scenarios, but the timeline matters enormously. In the near term, meaning the next 3 to 6 months, I think silver remains well supported. The 67 million ounce deficit isn't going to disappear overnight. Investment demand isn't going to evaporate while the Fed is still dovish, and geopolitical concerns remain elevated. Yes, we saw that massive 30% single-day drop in late January that took silver from around $118 down to current levels, but that was likely a blow-off top with excessive speculation getting flushed out. The underlying fundamentals haven't changed that dramatically. Here's a key number to watch. Support appears to be forming around $69 to $70. If we hold above that level, which I think we will, then we're likely to see silver consolidate in the $70 to $85 range through the spring. The Chinese Lunar New Year, which runs from February 16th to 23rd, typically sees reduced Asian trading volumes, so expect some choppiness around these dates, but physical premiums remain elevated, which tells me real buying interest exists at these levels. For the medium term, let's say 6 to 12 months out, this is where the industrial demand picture becomes critical. If we start seeing quarterly data showing accelerating substitution in solar beyond that 2% decline, if electronics manufacturers announce major efficiency improvements, if we get concrete evidence that industrial users are successfully engineering silver out of their products, then I think we're vulnerable to a significant correction. Not a crash back to $30, but definitely a move down to the $50 to $60 zone. However, and this is important, any such correction would likely be a buying opportunity because the long-term structural deficit remains intact. Looking at the longer term, meaning 12 to 24 months out, I'm actually quite bullish on silver despite the industrial demand concerns. Here's why. The substitution story in solar is real, but it's not the whole story. Silver has over 10,000 industrial applications. Solar represents a significant chunk, but it's not the majority of industrial demand. As our economy becomes more electrified, more digitized, more reliant on renewable energy infrastructure beyond just solar, silver consumption in aggregate should continue growing. The photovoltaic sector might plateau or even decline slightly in its silver usage, but other sectors are ramping up. There's also something called the price-supply response that we need to consider. At $80 silver, marginal mines that weren't economic at $30 suddenly become viable. We could see increased primary silver production come online, but again, this takes time. Mining projects have long lead times. Any new supply from higher prices won't hit the market until late 2027 or 2028 at the earliest. One more critical factor that doesn't get talked about enough: the gold to silver ratio. Historically, this ratio has averaged around 60 to 70, meaning it takes 60 to 70 ounces of silver to buy 1 ounce of gold. Right now, depending on the day, we're somewhere in the 70 to 75 range. If you believe gold is going higher due to central bank buying, deficit spending, and monetary debasement concerns, then silver often outperforms on the way up. That industrial component gives silver leverage to the upside when precious metals are in favor. So where does all this leave us? What should you actually do with this information? If you're a long-term investor who believes in the precious metals thesis, the solar substitution story shouldn't scare you out of your position. It's a headwind, yes, but it's one headwind among many cross-currents. The structural deficit, investment demand, supply constraints, and expanding industrial uses in other sectors provide significant tailwinds. I would use any significant dips, especially if we get back toward that $69 to $70 support level, as opportunities to add to positions. If you're a trader, the volatility we saw in late January should be a wake-up call. This market can move 30% in a day. Risk management is absolutely essential. Don't over-leverage. Don't put money into silver that you can't afford to lose. But the volatility also creates opportunity. we're likely to see significant swings within a range, and that range probably has $70 as the floor and $90 to $100 as the ceiling for the next several months. For those of you thinking about physical silver, understand that premiums remain elevated, which tells you something about real-world demand. The paper price might be $78, but you're probably paying $3 to $5 over spot for coins and bars. That spread matters. It also means that physical holders have a bit of a cushion if prices do pull back. The solar sector impact on silver is real. It's happening, and it will continue. But markets are complex adaptive systems. They don't move in straight lines based on single variables. The industrial demand softening is being offset by investment demand strength and supply tightness. How long that offset lasts is the billion-dollar question, or should I say the $80 per ounce question. Keep watching the monthly industrial fabrication data. Keep an eye on solar panel manufacturers' quarterly reports for any mentions of silver content reduction. Watch the Fed and their rate decisions. Monitor geopolitical developments, and most importantly, watch price action at those key levels I mentioned, $69 to $70 support and $84 to $85 resistance. The silver market in 2026 is providing us with one of the most interesting case studies in supply and demand dynamics that we've seen in decades. The next 6 months are going to tell us a lot about whether high prices truly destroy demand or whether the structural deficit story remains dominant. Either way, it's going to be a fascinating ride. If you found this analysis helpful, smash that like button, subscribe if you haven't already, and drop a comment telling me whether you think we're headed back to $100 or down to $60. I read every comment, and I'd love to hear your perspective. Thanks for watching, and I'll see you in the next one.